Group's M&A webinar series. Today, I'm joined by Richard Thomas, and we're going to have a discussion about value creation strategies to drive EBITDA expansion. We're really pleased everyone could join. Richard and I initially met back in our days at London Business School, where we did our MBAs together, and I'm really excited about the conversation today. Hi, Richard.
Hey, good to see you, Dave.
So let's do a quick housekeeping. And thanks everyone for joining us today. Just so you know, this session will be recorded and sent to all participants after the webinar. Listen only mode is on during the presentation, but we would love to get your questions. If you do want to provide a question to Richard, please submit it via the chat, and we'll have a Q&A session at the end of the webinar, time permitting. Let me introduce you quickly to myself and to Richard. I'm the founder of Burnie Group, founded in 2011. We focus on transforming our clients' performance, really leveraging technology and focusing on operations. Richard is the Managing Director of Value Creation in the Private Capital Group at Ontario Teachers' Pension Plan. He works closely with teachers' portfolio companies to identify and implement strategic priorities and value creation opportunities, and sits on the boards of Home Equity Bank, Landmark Financial, and Koru. So Richard will share insights and strategies on how to drive value creation. Welcome to the webinar, Richard.
Thank you.
Great. So Richard, maybe we could start off by having you give us a quick intro and telling us about Ontario Teachers' Pension Plan.
Yep, sure. So Ontario Teachers, as the name suggests, we exist to manage and invest for pensions of all the teachers in the province of Ontario. We have about 340,000 members, and those consist of about 180,000 working teachers. So these are teachers who are active in the classroom and making contributions to the pension. And we have about 160,000 pensioners. These are teachers who've now reached the end of their working career and are drawing down on their pension plan. So a ratio of about 1.2 working members to every one pensioner. And over time, that ratio is coming down a little bit. The pension plan is fully funded. I think we place a lot of stock in being over 100% in our funding ratio, and that really compares the present value of our assets to the present value of all of our future liabilities. And it is a fully funded defined benefit plan. So the benefits that our teachers receive are locked in and inflation adjusted. The plan is very international, as well as having significant scale in terms of the assets of about $250 billion Canadian. It has a global presence. Most people are based here in Toronto, but we have sizable offices in London and Singapore, and have recently opened a location in Mumbai. And that really reflects our desire to diversify the portfolio across geographies. Some fun facts. So among our pensioners, among the 160,000 or so pensioners, we have 148 pensioners who are over the age of 100. So it's a pretty nice statistic to share. There are 42 pensioners who have been receiving a pension for over 50 years. So the teacher's pension is a very long-running and established pension program. On average, our members will contribute to their pension for about 26 years and then draw on the pension for about 32 years. It's good. We invest that $250 billion across multiple asset classes. We invest in capital markets. We invest in infrastructure, natural resources. We have a venture growth group that invests in early stage investments, and that group is fairly new. That's about 5 years old. And then we have our private equity practice, which is where I sit. And to give you a little bit of color on the private equity practice, we've got roughly 60 billion Canadian under management in that group. And that's driven just under 20% returns since the group was started up. We invest in portfolio companies in each of those different geographies that I mentioned. And right now in the portfolio is about 65 companies that we have positions in. Over time, we've skewed more towards majority positions. So we look to take a control position, although we do have some sizable holdings in companies where we are the co-lead or the co-investor. There's a few differences between our private equity practice and a typical PE fund. And we put some of those down on the page there. A lot of those differences are really structural and reflect the fact that, we have liabilities stretching way out into the future. Back to that point, we have pensioners who are over 100 years old. So we think about matching our assets and the revenues or the returns we see on those assets to those liability streams going way off into the future. And that means we can hold assets for much longer than a typical investor. Typical PE fund might hold an asset for 3 to 5 years before needing to exit. We can accommodate much longer hold periods. And that's really because we don't have a need for liquidity in the short to medium term to return capital to an external limited partner. Check sizes, we have a lot of flexibility on that. I think on the page here, we talk about investing 100 million Canadian and upwards, and we're probably skewing larger in more recent years. And we always have the ability to provide follow-on capital. So unlike a typical PE fund that may be constrained or limited by the size of the fund, we can always look to continue to support investments over time with follow-ups. A couple of other advantages that we think we have, we do have access to all those different asset classes, and we do have access to our in-house capabilities, including Koru, which was set up probably 4 or 5 years ago to help our portfolio companies innovate. We recognize that many of our companies are very strong at what they do. They have great teams and really strong assets. But we recognize it can be hard to innovate. And so what Koru does is bring a different type of talent and a different capability around entrepreneurship and business building to those companies.
Great. Now, Richard, you work on the Teachers Value Creation team. Could you tell me a little bit about the Value Creation team and how you define value creation?
Yeah. So we have 10 people in the value creation team on a global basis. There's 6 of us here in Toronto. We have 3 people in London and 1 person in Singapore. And our role is to bring a slightly different lens. Most of the people in the private equity practice are deal professionals. They focus very much on the buy side, and they're originating deals, driving underwriting, and managing companies throughout the whole period. The value creation team brings a slightly different skill set, and we try to bring more of an operational or a general management or P&L background to the teams. And that really allows us to think differently about our companies. It allows us to think about strategy and operations, and allows us to bring some different real world experience, so that when we sit down with a management team and engage with them, it's not just on the basis of an investing thesis, but we can bring insights from our own experience. We can draw on our networks. And we think that goes a long way to being able to better engage with our management teams. In terms of what is value creation, well, for us, value creation is all around understanding, while we hold an asset in our portfolio, while we own it, what are the key things we can do to increase its value, so we see a positive return that meets our hurdle when we exit. Value creation then is identifying the key 3 to 5 levers that will increase asset value over the whole period. There's no magic to that number. In some companies, it may be a small group of key levers. Other companies, it may be more. But typically, we really want to understand what are the 3 to 5 levers we're going to pull. We then want to start to develop a comprehensive plan around those levers early on in our whole process. And we want to engage very closely with our management teams, with the CEOs and their direct reports, to help support and oversee execution against the plan. So at Teachers, we think and we believe all of our companies should have a clear view on the value creation goals. And those goals should really reflect our belief about the company. It should reflect tailwinds that we see in the industry. It should reflect what we think is our right to win. It should reflect any proprietary assets that we have. And we try to pull all those pieces together in a value creation plan. In some cases, a company may already have a strategic planning process, so there's no magic to the name value creation plan. We may refer to a 5-year plan, a 5-year strategy, or some other kind of process. But typically, we're looking for some kind of formalized document that we can look at and we can tie back to, and we can use to track and monitor process. In some cases, that value creation plan might be put down or might be put together in close engagement with the management team at the start of the whole period. And in other cases, the management team may already have a strong plan in place, but we go in and validate and work with and then continue to follow through. When we think about value creation plans, a good value creation plan, typically does a few things. It prompts choices. It prompts us to think very carefully around what are we going to do over the whole period, and equally importantly, what are we not going to do? So it should drive focus on those top 3 to 5 initiatives. It should define where we play and how we think we'll win. And it should include some deliberate steps to improve business performance and to boost returns. Again, so it's tying back to our underwriting thesis. And then crucially, a good value creation plan should really clearly identify who is accountable and who is accountable on the management team to own those initiatives. And it should lay out very clear KPIs and metrics so that as we go through the whole period, we have a really good understanding of where we are and what progress we're making.
That's great, Richard. I've actually found it quite rewarding. We've worked with some of your portfolio companies and directly with teachers to do some of that value creation planning. And it's always great to take a step back and help those leaders really build a path forward for the future.
That's actually a good point. It's good. So we have our value creation team, but as I said, we're a pretty small group of just 10 of us covering 65 companies. Mm-hmm. So there is definitely a role for external advisors to play, particularly early in the whole period when we're looking to engage with a new company and engage with a new asset. And you've referenced a couple of the engagements that Burnie Group has helped us with, and that's been very helpful, I think, to bring more insights, different perspectives, and knowledgeable resources to really probe and go much more deeply into the value creation plan. Because I think we find during the deal process, you have a really good set of information from the company, but sometimes you're time constrained, you don't have full access to management. So having more horsepower as you get that early engagement after the deal can be really helpful sometimes.
Right. And how do you think about value creation throughout the deal lifecycle? Are you only involved once a company is acquired, or are you actually working with deal teams throughout?
We really try and engage throughout the life cycle. So if I take a step back, we would think about a deal life cycle as starting with origination, and that's when the deal teams are identifying areas of interest or subsectors. They're building up a view on what their investment thesis is. Then you typically roll into diligence. So as you start to engage in a process, you're undertaking diligence on the company, either with your own resources or with external support. You then do the deal, you roll into onboarding, bring the company in as you start to close. You then have that fairly extensive hold period. As I said, most PE funds, probably 3 to 5 years. For us, some of our assets we can hold much, much longer. Right now, I'm working with one of our companies that we feel would probably hold for about 10 years. And then you exit. And with private equity, there always has to be an exit. And you're right, we do think about value creation across each of those phases. So in the origination stage, we think it's important for the value creation team to be engaged. Again, we bring that real world expertise, we bring that operational background. So we find it's good to act as a sounding board for the deal teams to pressure test hypotheses and start to do some early work on what we think those key value creation levers will be. But it's typically a fairly light lift during the origination phase. As you move into diligence, I do think there's a strong role for value creation professionals to play. And again, it goes back to having that industry background. But there you can start to lean in and start to talk about how are we going to scope diligence? What advisors will we select? Where do we really need to probe? And what information do we truly need to get during the diligence phase to give us confidence in that value creation plan? Moving from diligence, we'll then do the deal. We'll start to onboard the company into the teacher's portfolio. And at this point, we invest quite heavily in alignment. And we have a tool that we use called the alignment survey. And there's no real rocket science behind the guts of it. We typically use SurveyMonkey, but the alignment survey is probably 20, 25 questions that really probe very deeply into how all the stakeholders are feeling about the company and the opportunities it has and the capabilities. We send that survey to the management team, so to the CEO and all their direct reports, and sometimes we'll go a layer or two deeper in the organization as well. We'll send it to any continuing board members, and we'll send it to the deal team as well. And we find it very, very useful to get those different perspectives once you've gotten through the deal. During the deal, the process is pretty tightly managed. You may have bankers who are coordinating back and forth. You have an information memorandum, you have a data room. But once you actually close the deal or get closer to closing, you get proper access to the management team. And that alignment survey is a great tool then to really uncover how do people feel about the business and the opportunities. So we will probe on what do people feel is the potential for the company. We'll probe on some of the strategic levers. We'll look to pressure test the capabilities that the company might have and identify areas that need investment. We've seen really good engagement on that alignment survey. On one we did a year or so ago, I think the CEO spent about 80 minutes filling it in, because you can see on SurveyMonkey how long people take, and you get really, really good verbatim comments and a really good, rich insight that then feeds into an alignment workshop that we kick off. And that's when we'll spend half a day with all those people together, talking in depth about the company, about the strategy, and starting to drive alignment on the value creation plan and those levers. The work doesn't stop there. Then there's significant follow-on work to really go much more deeply into co-creating the value creation plan and then some kind of execution roadmap and putting the various pieces in place. But that onboarding phase is really where the heavy lifting comes in. Onboarding is also a time when we can start to use some other tools that we have. So I mentioned the alignment survey. It's often a good practice to start to map talent to value, which is really saying when you've identified those value creation levers, do you have a good sense of who in the organization is accountable and who has the skills and the assets and the capabilities to deliver? A traditional organization chart would suggest it's the CEO and their direct reports that are most tightly tied to driving value. But when you truly map talent to value, you see, hey, there might be somebody 2 or 3 levels down in the organization, or you might identify a gap or a capability that you need to build several levels down. Mm-hmm. After onboarding, we'll roll into the whole period, several years. And that's really when you need to see the value creation plan embedded in the regular processes. So, quarterly board meetings should include a discussion of value creation. The board meetings, we should see the value creation scorecard, and we should see progress against those KPIs that we'd outlined earlier on. And at that point, it's important, I think, to see really good alignment between the value creation plan and scorecards that are put in place by the board for the management team.
That's great. And Richard, I've seen some of the value of that alignment survey when you have just big differences of opinion from the board to the senior leadership to the middle leadership. So it's really good to get that out on the table. Now you've been through countless value creation processes with your portfolio companies. Really interested to understand, what are some lessons learned? What are some things that you've seen that others might be able to think about as they go through and develop their strategies for the future and really seek to drive that value?
So I think the first one is we approach this from the investor perspective, and we can provide resources and help to drive the strategy, and we can push for alignment. But ultimately, the value creation plan shouldn't be owned by the investor. It shouldn't be owned by Ontario Teachers or the PE fund. The value creation plan needs to be owned by management. It needs to be management-led. It needs to be management-driven, which is why I think it's so important to go through that early process of gaining alignment. Because ultimately, a board can show up and define objectives and set objectives and push them down. Mm-hmm. But I think you're setting yourself up for future trouble if you don't have that early alignment. So we can play a role. We can bring in partners such as the Burnie Group to play a role, but ultimately management needs to own that value creation plan.
Right. And how do you make sure that they own it? Have you ever had any situations where the management's team like, great, I just got acquired, now I can just sit back and relax, you guys tell me what you want me to do, and not truly own that plan going forward?
No, I haven't seen quite that. And I think what we try to do is ensure that there's clear alignment between the plan we've agreed upon, the scorecards that are in place, and then the incentive structures that are in place for the CEO and their top team. And those incentives are, typically in private equity linked. So options, a form of equity ownership through an employee share ownership plan, something like that, to make sure that everybody is truly focused on the same goals and everybody realizes value in the same way. So making sure that long-term equity alignment is there, short-term scorecard goals tied to the KPIs, tied back to that plan that we agreed upon, making sure that it's all coherent and ties together.
Great. Other lessons learned?
Yeah, it needs to be tailored. So a good value creation plan should be tailored to the company and to the management team. There's no one size fits all approach. It's not as if we can say, hey, we're investing in this sector, therefore this plan, we'll just dust it off, we'll change the name and apply it, and away we go. I think that's not a good approach at all. I think instead you need to truly understand the company and its capabilities and the industry and the sector in which it plays, and then make sure that the VCP is truly tailored to the organization.
And are leadership teams open to that? Because often they've gotten to where they are because they've been very successful. Do they sometimes view this as meddling, or hey, we've got this, we've got our plan together, so no need to change it?
There's absolutely strong management teams in whom we invest who have this, and that's often part of the attraction. We invest in really solid, high-performing companies with great teams in place. And so actually it can quite often be the case that we have a strong team in which we're investing, and there's already strong alignment. They already have a strong strategic plan in place. And at that point, it may be validation. At that point, the value creation plan exercise might be more around truly understanding, do we have the right resources? What happens if we put more gas on the fire? That type of thing. So even so, I think it's still important, even if there's a strong plan and a strong team behind it, I think it's still good and healthy to go through the alignment process, even if it does nothing else than reset and reframe the KPIs that you're going to use and make sure that you're fully aligned on those.
Great.
What else? I think it's important to get early alignment on ambition. So there should be good alignment between the investor and the management team on the level of ambition. So are we going to double this company? Are we going to triple this company? I think you set yourself up for trouble if one party is looking at a much lower level of growth or level of ambition. Right. So getting, again, early alignment is key.
The alignment survey really helps.
Should come back to that. Yeah, should really come back to that. And I think it's important as well to, this applies not just to value creation plans, but more broadly. Don't let perfect be the enemy of good. Or to put it another way, done is better than perfect. So strategic planning, like many things, you can spend hours and hours, days, months, continuing to polish and refine a plan. And there's probably always one extra data point you'd love to have, and you'd always love to socialize it just a little bit more and come back and revisit. I think you need to have a good alignment and good strength and good trust between the investor and the management team. But you get to a certain point and okay, this is good. We're aligned. Let's go. Let's not continue to polish it.
Great. Any other things that you've seen through your journey of value creation?
A couple of other quick things. I think I touched on this already. I think consulting resources can be a great help. We can be really useful in bringing external perspectives or additional resources to help shape the value creation plan. But ultimately, you shouldn't rely on consultants for implementation. Back to the point that the management team needs to own this and needs to take this on. And if they choose to use external resources in the future, that's great. But again, they need to use this. I think we've seen cases where you can't rely on a great value creation plan to prop up a weak management team. So you need to make sure, hey, we've got a great strategy, we're all aligned, and we have the right talent in place to help deliver on this.
How quickly do you move on that if you realize that there is some weak links on the management team? Like, do you give it when's the right time to make some changes?
There's no right answer to that. I think so many things are dependent. I think ideally you would look to do a really solid management assessment early in the hold period. So you get through the deal, you align on the value creation plan, you get a really good understanding of the levers and the capabilities you need. And then you should go through and assess the talent that you have in the organization. And the third parties that can help with this, the search firms in particular, have good management assessment practices where you should then go back and assess your top talent against the needs of the business. And I think doing that early is probably a healthy thing to do.
Right. Makes sense.
That's good. And then, we can hold assets for quite a long time, so you shouldn't be afraid to refresh or reset a value creation plan. It's probably a good practice to dust it off every so often and continue to ask yourself, is this fit for purpose, particularly if the business circumstances or the market circumstances change.
Great. So Richard, those are some really good insights about driving EBITDA growth. Any good case studies or examples where you, through your work in the value creation team, have seen a meaningful change in direction of the company and direction in its performance?
Yeah, I think the proof of the pudding is always in the eating. I think we've got some really nice case studies across the portfolio at Teachers, where we've engaged with management, we've gone through that process, we've agreed on a plan, and we've been able to bring incremental assets or resources to bear. So I have one great case study in mind where we've invested in a platform company, a software company, and they've gone on a really good path of growth through M&A. And there, we've built on the existing capabilities that the team had and really supported them to go through and add additional products and services inorganically to the point now where their acquired EBITDA has driven up dramatically, and you can really see the impact on the value of that company. On another case study, we went into an investment, and we really thought there'd be a strong benefit from focusing on innovation. This is a company that has been something of a monoline for many years, and we thought it would really benefit from bringing in Koru to help identify how can we enter new segments, how can we do some new product development, and that process has gone through, and now we see a new product line come to life and adding to the bottom line.
Right, great. Now we're in an interesting environment, rising interest rates, capital markets have been relatively slow. What are some of the themes that you're seeing with your portfolio, with Teachers portfolio companies, that you're helping them with as a result?
So whole periods are getting extended across the industry. So it's probably no surprise the impact of high rates has slowed deal activity. So I think pretty much every investor is looking inward at their existing companies and working more closely with management as opposed to focusing more on origination and exits. And so we've been working with our companies, in a high rate environment, on managing expense, on really focusing on procurement initiatives. Because if you think we can help lean in on growth, we can help lean in on cost savings, on cash management. And I think in tougher times, you need to continue to focus on growth, but there's more of a push to really stare very heavily at SG&A expenses and procurement and what have you. And so throughout the cycle, I'd say the mix of our focus area changes a little bit.
Great, makes sense. All right, well, Richard, I think we are approaching the end of our time. So thanks very much for the insights that you bring about value creation. I know Teachers has been had a great record of performance as it relates to its portfolio companies. So clearly you're making an impact.
Thank you.
So maybe I will touch on our next webinar series, which is on May 15th. John Bogert from Resolute Health will be speaking with Graham Hartland from Burnie Group, and their focus will be on proven strategies for maximizing buy and build roll-up success. So it should be really interesting discussion. So Richard, on behalf of Burnie Group, thank you very much for your time, and I'm confident everyone found some good, meaningful nuggets from the conversation.
Thank you. Good to see you.
All right. Bye now.
Bye now.